I suppose you want to know what an old man thinks about investing in 2026. Fair enough. I've lived through quite a few eras now: the Great Depression, World War II, the go-go 60s, stagflation, the dot-com mania, the housing crisis, and now whatever circus we're calling this current moment. And let me tell you something. The more things change, the more human nature stays exactly the same. You know, I look around today and I see artificial intelligence, cryptocurrencies, meme stocks, trading apps that make speculation feel like a video game. Everyone's got an opinion. Everyone's got a hot tip. The noise is deafening. And through all of it, most people are making the same ancient mistakes that have destroyed capital since the beginning of markets. So if you're here hoping I'll tell you which AI stock to buy or whether Bitcoin's going to $1 million, you're in the wrong room. I don't do that. Never have. What I do is think clearly about fundamentals, avoid stupidity, and let compounding do its quiet, miraculous work. If I were starting today, 25 years old, with nothing but time and the need to build wealth intelligently, what would I do? That's the question. And I'll tell you, but first, let me set the scene, because you can't understand the answer without understanding the world you're actually living in. We're living in strange times, not bad times necessarily, just strange. You've got technology advancing faster than most people can comprehend. AI isn't science fiction anymore. It's writing code, diagnosing diseases, generating art. It's real, and it's going to change everything. But here's the thing. It's also going to create a lot of losers, because whenever there's a gold rush, most of the miners go broke. The people who get rich sell the picks and shovels. That was true in 1849, and it's true now. Then you've got speculation running wild. I've seen this before. When money's too easy and people think the rules don't apply, they do crazy things. They buy tokens with cartoon dogs on them. They trade stocks based on Reddit threads. They think they're investors when they're really just gamblers. And look, I've got nothing against gambling. Las Vegas is a wonderful place if you know what you're doing. But don't call it investing. Interest rates have been through a roller coaster. Inflation came back with a vengeance, just like some of us said it would when the money printers were running hot. Now, central banks are trying to clean up the mess. Bonds aren't what they used to be. Stocks aren't cheap. Real estate's been bid up in a lot of places. There's no free lunch anywhere. And on top of all that, you've got geopolitical tensions, climate concerns, and a general sense that the system's a little fragile. Maybe it is, maybe it isn't. But that uncertainty creates fear, and fear creates opportunity if you know how to stay rational. So that's 2026. It's a world full of complexity, noise, and temptation. It's also a world full of opportunity for the patient and the rational, just like every other era. Now, let me tell you what doesn't change. The fundamentals, the boring stuff that actually works. First, compounding. Einstein supposedly called it the eighth wonder of the world. I don't know if he actually said that, but it's true anyway. Compounding is the single most powerful force in finance, and almost nobody has the temperament to let it work. They want results now. They want to get rich fast, and so they interrupt the process. They trade too much, they chase returns, they panic and sell at the bottom. If you can get a 10% annual return and you start with $10,000 at age 25, by the time you're 65, you'll have nearly $500,000. That's without adding another penny, just letting it sit. Now, if you add money regularly, say $500 a month, you're looking at well over $2 million. That's compounding. That's the magic. But you have to leave it alone. That's the hard part. Second, avoiding stupidity is more important than being brilliant. Warren and I figured this out early. We didn't try to be geniuses. We just tried not to be idiots. You know the old saying, it's remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid instead of trying to be very intelligent. Most investment disasters come from doing something dumb, over-leveraging, buying what you don't understand, following the crowd, letting emotions drive decisions. If you can just avoid the big mistakes, you'll do better than 90% of people. It's that simple. Third, stay within your circle of competence. This is critical. You don't have to understand every business in the world. In fact, you shouldn't try. What you need is a few areas where you genuinely understand how value is created. Maybe it's retail, maybe it's software, maybe it's industrial equipment. Whatever it is, stay there. Don't wander into oil and gas if you've never studied it. Don't buy biotech stocks because someone said they're hot. Warren and I have passed on thousands of opportunities over the years, not because they were bad, but because we didn't understand them well enough. That's discipline. And discipline is what separates investors from speculators. Fourth, time horizon matters. If you're investing money you'll need in 2 years, you're not investing, you're speculating. Real investing is long term. 5 years minimum. 10 years better. 20 years ideal. Because in the short run, markets are voting machines. In the long run, they're weighing machines. Quality wins. Patience wins. And fifth, incentives rule the world. This is one of the most underappreciated truths in all of investing, maybe in all of life. Show me the incentive, and I'll show you the outcome. Understand what motivates the people running a company. Understand what motivates your broker, your financial advisor, the talking heads on TV. Most of them are not incentivized to make you rich. They're incentivized to keep you active, to keep you trading, to keep you paying fees. Once you see that, everything becomes clearer. Let me tell you about stupidity. Not because I enjoy being mean, but because avoiding stupidity is 90% of the game. Mistake number one, thinking you're smarter than you are. Overconfidence kills. I've seen brilliant people, engineers, doctors, lawyers come into the markets thinking their intelligence will give them an edge. It doesn't. In fact, it often makes things worse because they're confident in their wrongness. The markets don't care about your IQ. They care about your temperament. Mistake number two, envy. Envy is the dumbest of the deadly sins because you don't even have fun committing it. But it's rampant in investing. Your neighbor makes 50% on some tech stock. Your colleague brags about his crypto gains. Suddenly, your boring 12% annual return feels like failure. So you abandon your strategy and chase. That's when you lose. I'll tell you something Warren taught me years ago. It's not greed that causes the most trouble in investing. It's envy. Greed at least has some logic to it. Envy is just pure poison. Mistake number three, confusing a bull market with genius. When everything's going up, everyone thinks they're Warren Buffett. They attribute their gains to skill, when really it's just the rising tide. Then the tide goes out, and as Warren says, you see who's been swimming naked. Don't be that person. Stay humble. Stay skeptical of your own success. Mistake number four, using leverage. Leverage is how smart people go broke. You might be right about an investment, but if you borrowed money to make it and the timing's wrong, you're finished. We've never used meaningful leverage at Berkshire. Never needed to. The world's full of people who were right but went broke because they borrowed. Don't be one of them. Mistake number five, following the crowd. The crowd is usually wrong at the extremes. When everyone's bullish, that's when you should be careful. When everyone's panicking, that's when you should be buying. But this is psychologically brutal. It requires you to act against your instincts, against social proof, against what feels safe. Most people can't do it. And mistake number six, this is a modern one, thinking that because you can trade instantly on your phone, you should. These apps are designed to make trading feel like a game. They give you dopamine hits with confetti when you buy a stock. It's all engineered to keep you active. But activity is the enemy of returns. The best investors do almost nothing. They buy great businesses and sit. So now the practical part. If I'm 25 years old in 2026, what do I do? First, I'd get my financial house in order. That means no high interest debt. Credit card debt at 20% interest is an emergency. You can't invest your way out of that hole. Pay it off. Live below your means. This isn't glamorous advice, but it's essential. You can't build wealth if you're hemorrhaging money on interest payments. Second, I'd build an emergency fund, 3 to 6 months of expenses in cash or something very liquid. This isn't an investment. This is insurance against stupidity, your own or the world's. It keeps you from having to sell investments at the worst possible time because you lost your job or had an unexpected expense. Third, and here's where it gets interesting, I'd put the majority of my money in a low-cost S&P 500 index fund. Yes, I said it. Charlie Munger recommends an index fund. You know why? Because I'm being honest about what most people can actually accomplish. The data is very clear. Over long periods, the S&P 500 beats the vast majority of professional money managers. Not because the professionals are dumb, many of them are quite smart, but because of fees, because of trading costs, because of the difficulty of consistently picking winners. And if the professionals can't beat the index, what makes you think you can? Now, Warren suggested that his estate should be invested 90% in an S&P 500 index fund. That tells you something. This isn't theoretical. This is what the greatest investor of all time recommends for most people. The beauty of the index is that you get diversification, you get low costs, and you get to ride the long-term growth of American business. It's not exciting. Nobody's going to be impressed at parties, but it works. It really, truly works. Fourth, I'd invest regularly, every month, like clockwork. This is called dollar cost averaging, and it does two wonderful things. It forces you to invest consistently, and it means you buy more shares when prices are low and fewer when they're high. You don't have to time the market. You just have to show up. Now, once I had this foundation in place, and we're talking about 80-90% of my investable assets, then and only then would I consider individual stocks. But here's the key. Only within my circle of competence, and only if I can buy at a reasonable price. What would I look for in an individual stock? I'd look for businesses I can understand. Businesses with durable competitive advantages, what Warren calls moats. Businesses with honest, capable management. Businesses that produce something people need and will keep needing. And I'd want to buy them at prices that aren't insane. You don't need to find 100 of these. You don't even need 10. If you can find 3 or 4 great businesses at reasonable prices and hold them for decades, you'll do extraordinarily well. That's what we did at Berkshire. We didn't buy hundreds of stocks. We bought a handful of great ones and held on. Fifth, I'd read constantly. I'd read annual reports. I'd read business biographies. I'd read about psychology and decision-making and history. Warren and I both spend enormous amounts of time just reading and thinking. That's our job. And it should be yours too, if you want to be good at this. You can't build wisdom without input. And you can't make good decisions without understanding the patterns of the past, the nature of human behavior, the structure of different industries. This stuff compounds too, just like money. Sixth, I'd be patient, painfully patient. There will be years where nothing happens. There will be years where your portfolio goes down. There will be long stretches where it feels like you're missing out on whatever everyone else is making money on. That's fine. That's part of it. The big money isn't in the buying and selling. It's in the waiting. And seventh, this is important, I'd avoid certain things entirely. I wouldn't touch cryptocurrency. I know that's unpopular. I know people have made money on it. But I don't understand the intrinsic value. I don't understand why it needs to exist. And I think most of it's rat poison squared, as Warren says. Maybe I'm wrong. Maybe I'm just old. But I'm comfortable being wrong about something I don't understand and don't own. I wouldn't trade options. I wouldn't use leverage. I wouldn't buy SPACs or whatever the new financial engineering gimmick is. I wouldn't buy a stock because it's trending on social media. All of that is noise. All of that is a distraction from the simple, boring work of buying good businesses and holding them. Now, let me address some specific things about this era, because you're probably wondering, what about AI? What about inflation? What about all the things that feel different? AI is real. It's going to create tremendous value and tremendous disruption. Some companies will benefit enormously. Others will be wiped out. The question is, can you tell which is which ahead of time? Maybe, if you really understand the technology and the business models. But most people don't. They're just guessing. The safer play is to own the index, which will capture the winners automatically. Or own the infrastructure plays, the companies providing the picks and shovels for the AI gold rush. Microsoft, Nvidia, companies like that. But even then, be careful with valuation. No company is a good investment at any price. Inflation is another concern. We've had a reminder recently that inflation isn't dead. It can come back, and when it does, it's a thief. It steals purchasing power from anyone holding cash or bonds. The best hedge against inflation, historically, has been ownership of productive assets, stocks, real estate, businesses that can raise prices. That's another reason to own equities for the long term. Companies, good companies, can adjust to inflation. They raise their prices, they maintain their margins. Cash just sits there and loses value. What about concentration risk in the index? It's true that the S&P 500 today is heavily weighted toward a handful of tech giants: Apple, Microsoft, Alphabet, Amazon, Nvidia. If you're worried about that, you can diversify further, add some international exposure, some small cap value, but don't overthink it. The index has adapted through every era, and the winners of one decade get replaced by the winners of the next. What about the national debt, the deficit, the potential for crisis? Look, there are always things to worry about. There always have been. If you wait for the all-clear signal, you'll wait forever. The world's always uncertain. The key is to build a portfolio that can survive a wide range of outcomes. Don't bet everything on one scenario, whether it's hyperinflation or deflation or whatever else keeps you up at night. Here's the thing nobody wants to hear. What I've described is simple, but it's not easy. Simple and easy are not the same thing. The strategy is simple. Buy low-cost index funds, invest regularly, hold for decades, avoid stupidity. A child could understand it, but executing it requires temperament. It requires discipline. It requires patience. And most people don't have those qualities. They get bored. They see their neighbor making money on some hot stock, and they abandon the plan. They panic when the market drops. They convince themselves that this time is different, that the old rules don't apply. They trade too much, chase performance, let emotions drive decisions. That's why most people fail, not because the strategy is complicated, but because they can't stick to it. They lack the temperament. And temperament, unfortunately, is not something you can easily teach. Some people have it, some don't. You can improve it. Studying psychology helps, studying history helps, studying your own past mistakes helps. But fundamentally, investing success is about controlling yourself, not predicting the market. If you can sit quietly while everyone else is running around like maniacs, you'll do fine. If you can avoid envy when your friends are bragging about their crypto gains, you'll do fine. If you can stay rational when fear and greed are pulling at you from all sides, you'll do fine. But that's the hard part. That's what separates the people who get rich slowly from the people who stay poor or blow up trying to get rich quickly. Let me zoom out for a moment and talk about what all this is really for. Because investing isn't the point of life. Money isn't the point of life. These are tools, not destinations. The purpose of building wealth, at least the way I see it, is to achieve independence, not to buy yachts or impress people. Independence, the ability to do what you want, when you want, with whom you want, the ability to say no, the ability to avoid doing things you find distasteful just because you need the paycheck. That's freedom. That's what money should buy. And the beautiful thing is, you don't need to be a billionaire to achieve it. A sensible person who lives below their means and invests the difference can become financially independent in a couple of decades. It's not glamorous, but it works. And here's something else. The habits that make you a good investor make you a better person. Rationality, patience, delayed gratification, resistance to social proof. These are virtues. They serve you in every aspect of life, not just in the stock market. Warren and I have always believed that how you make your money matters. We've avoided industries we found morally questionable. We've avoided tricks and gimmicks and financial engineering. We've tried to be good stewards of other people's capital. Not because we're saints, we're not, but because we think there's a right way and a wrong way to do things. You can get rich doing things that are harmful. Plenty of people have. But you'll sleep better if you don't. And you'll be more useful to the world if you create value rather than just extracting it. So let me bring this home. If I'm starting from zero in 2026 at age 25, here's my complete plan. I'd get a job that pays decently and that I can tolerate. It doesn't have to be my passion. It doesn't have to be glamorous. It just needs to provide income and not make me miserable. I'd live well below my means. I'd rent a modest place. I'd drive a reasonable car. I'd avoid lifestyle inflation. Every time I got a raise, I'd save the difference rather than spending it. I'd eliminate any high-interest debt as fast as possible. This is the first priority. You can't build wealth with credit card debt dragging you down. I'd build an emergency fund of 6 months' expenses. This goes in a high-yield savings account. It's not exciting, but it's essential. Then I'd open a brokerage account, something with low fees, like Vanguard or Fidelity, and I'd start investing in an S&P 500 index fund every month, automatically. Say $500 a month if I could afford it, more as my income grew. I'd max out any retirement accounts available to me, 401, IRA, whatever, especially if there's an employer match. That's free money. Always take free money. I'd read for at least an hour every day. Business books, biographies, annual reports. I'd study the masters, Benjamin Graham, Warren Buffett, Peter Lynch. I'd study psychology, Daniel Kahneman, Amos Tversky. I'd study history. All of this compounds. I'd avoid the noise. I wouldn't watch CNBC. I wouldn't check my portfolio every day. I wouldn't follow stock tips on social media. I'd ignore 99% of financial news because 99% of it is useless. I'd review my portfolio once a quarter, maybe, just to rebalance if needed, just to make sure I'm still on track. That's it. No trading, no tinkering, just steady, boring accumulation. And I'd wait for decades, through booms and busts, through manias and crashes, through whatever the world threw at me. I'd keep working, keep saving, keep investing, and I'd let compounding do its work. By the time I was 55 or 60, I'd be financially independent. Not rich enough to buy sports teams, but rich enough to do what I wanted. Rich enough to say no to things I didn't want to do. Rich enough to help people I cared about. Rich enough to fund causes I believed in. That's the plan. It's simple. It's boring. It works. Look, I know this isn't what most people want to hear. They want excitement. They want to hear about the next Amazon or the next NVIDIA. They want to believe there's a secret, a shortcut, a way to beat the system. There isn't. Or if there is, it's available to such a tiny number of people that you're almost certainly not one of them. And that's okay. You don't need to beat the market. You just need to participate in it over long periods. The stock market is a wealth-creating machine. It has been for centuries. It will continue to be, despite wars, depressions, panics, crises, through all of it. The trend has been up because human ingenuity finds ways to create value, because companies adapt and innovate, because the incentives push toward growth. All you have to do is own a piece of that machine and leave it alone. That's it. That's the whole secret. But people can't help themselves. They think they need to do something. They think action equals progress. So they trade, they speculate, they follow the crowd, and they underperform. The world's full of foolish gamblers, and they'll keep the casinos busy. Let them. You don't have to join them. You can take the rational path, the patient path, the path that actually works. And here's the beautiful part. If you do this right, you'll not only build wealth, you'll build character. You'll learn to think independently. You'll learn to control your emotions. You'll learn the value of patience and discipline. These lessons will serve you far beyond investing. I've had a long life. I've seen a lot. And I can tell you that the people who get wealthy slowly, rationally, patiently, they're usually the happiest. The people who get rich quick often end up miserable, or they lose it just as quickly as they made it. There's a reason the old virtues are still virtues. Patience, rationality, humility, discipline. These aren't just moral qualities. They're practical ones. They work. They've always worked. They'll keep working. So if you're young and you're starting out, my advice is this: ignore the noise, ignore the speculation, ignore the people trying to sell you complicated strategies or hot tips. Just buy good businesses, or better yet, buy the index and hold them for decades. Live below your means. Avoid debt. Read constantly. Think independently. Do that and you'll be fine. More than fine. You'll be wealthy. In the only sense that really matters, you'll be free. And if you can do it without compromising your integrity, without harming others, without losing sight of what really matters in life, well, then you'll be rich in every sense. That's what I'd do if I were starting over in 2026. It's not complicated. It's not exciting, but it's true. Thank you for listening to an old man ramble. Now go forth and be rational. The world needs more rationality. And remember, a lot of success in life and business comes from knowing what you want to avoid. Avoid stupidity, avoid envy, avoid impatience, avoid the herd. Do that, and compounding will take care of the rest. Good luck.